Hi, this is Vijay Bambani here, and I'm recording this video as usual from the comfort and safety of my house. I'm staying indoors, obeying the lockdown instructions. I hope you're staying indoors and protecting yourself and your family by complying with the lockdown instructions. A few more days and this will all be over. But for now, I want to caution you about what's happening in the hard asset market. By hard asset markets, I mean commodities, currencies, crude oil, natural gas, base metals, etc. Since the last few days, what I have observed is the cost of carry. Cost of carry is the rollover cost or the financing cost that you pay if you want to roll over your long positions or your purchases from 1 month to the next month because you expect higher prices, or you have purchased and the price has come down and you would still want to take a punt or bet that the prices will recover later. Now for waiting for another month and rolling over your long positions from month 1 to month 2, which is for example April to May 2020, you need to pay some financing charges. To my utter horror, since the last few days, I have been noticing that the cost of carry in crude oil is 35%. Now, before you ask me, what is 35%? Let me assure you, I am talking of 35% per month, which is a whopping 420% per annum. Now, if you were to actually compute and take a hypothetical situation that the Saudis have reached a kind of a oil output cut pact with the Russians, the other countries which are not even a part of OPEC, which is now called OPEC Plus, have also agreed to cut output of crude, and therefore the crude prices might just go up exponentially. Ask yourself this question: can crude oil prices jump by 420% per annum for you to justify paying this kind of financing charges? And we are all practical realists. We are traders who live in the real world, bet our money, put our money on the line of fire to earn profits. We also know that there is something called an execution cost, brokerage, taxes, STT, stamp duty, exchange charges, etc., etc. Now, if you were to add those charges, it means the 420% cost of carry that you're paying needs to be supplemented by a minimum of 10% more, which means if the prices of crude were to rise by 430%, you would just be breaking even. Is this kind of a risk justified? Do we expect the price of crude to really jump this much? So 35% in the month of May as compared to the price of April, and on an annualized basis, do we expect the price of crude to jump by 420%? My answer is an emphatic no. Is this something in isolation? No, I don't think so. If you were to check out the cost of carry that the USD INR, which is the United States dollar, versus the Indian national rupee, you will see that the cost of carry has now jumped to between 35 to 40 paise from the month of April to the month of May. Historical average is between 18 to 22 paise, which means the cost of carry is now jumped to double. Now, this is the kind of irrationality that you should always avoid. Sometimes, like I've told you in my earlier videos, sometimes not doing anything is also a part of the plan. Conserving capital, which professional traders call keeping the powder dry, is also a part of the larger, broader game plan of a savvy professional trader. You need to ask yourself the question, will I actually make any meaningful money by paying 420% interest per annum? I leave the answer to you. And from here on, we need to wait for normalcy to return, not just in the cost of carry, but also in all asset classes where these kind of imbalances have occurred, you need to go back to your normal ranges. That will take some time. Remember, in financial markets, whenever such extraneous white or black swan events occur, there will always be unscrupulous elements who will try to make money off the retail trader. It is up to you to be the protector of your capital and see to it that you do not get entrapped into such market anomalies. There will be a lot more such disequilibriums, imbalances in prices as long as the fear of corona continues. Till then, I would suggest trading very, very quietly, maybe sometimes not even trading if that is required, and not computing the value of money in the number of calls that you're receiving from your service provider, but focusing on the return on investments or return on capital that you have deployed over a 12-month period as value of money received. Right now, this is not a time to get aggressive. Let's be careful out there, both in terms of our lives, by staying indoors, and with our capital, by not taking aggressive bets in the markets. As the commodity player Anduran says, the markets are broken. The commodity markets appear broken as of now. Let's wait for equilibrium to return. In anticipation of better times, this is Vijay Bambwani signing off from this video for now, till we meet again in my next video. But before I log off, let me remind you to click like on this video if you're watching this on YouTube. Do tell me in the comments section what you think about this video and what you would want me to record in my future videos. Also, do not forget to share this video with your family and friends. And let me remind you also that we are on Telegram with the handle Equity Master Official. Do join the Telegram channel wherein I put up 3 to 4 updates every day, Monday to Friday, and I would love to share my ideas with you. See you out there. Take very good care of your family and your investments. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.